Let me now bring on board Alroy Lobo, Chief Equity Strategist and Global Head Equities with Kotak AMC. Alroy, morning. Thank you for joining us. So what's been the portfolio strategy at Kotak AMC? Are you riding the momentum, or it's time to take some chips off the table?
I think at the margin, clearly things have bottomed out, and I think going forward we are seeing a turn in number of macro variables. So to that extent, we are fully invested, and we're actually participating in this market.
Alroy, what have you made of the Nifty's consolidation around the 5400 mark? I mean, what chance, or rather, how much of a chance do you think that the Nifty has to post a breakout above this level, given the macro environment that we're currently with, and the fact that this move that we've seen in equities is just liquidity driven?
No, I think, to a large extent, we have seen quite a few policy initiatives which have been positive for markets. Clearly, from an India front, we are moving from a tightening cycle to an easing monetary, cycle. Which itself is positive, because during a tightening cycle you did see India underperform massively. In fact, India was the worst performing market last year. So in an easy monetary policy cycle, I think you would see investors returning back to India. Second is we have a few events which are lined up in March. One of them is clearly the state elections in Uttar Pradesh, where we believe it could be positive for markets. Second is the budget that is coming up on March 16th. We do believe it's going to be a constructive budget as far as fiscal consolidation is concerned. And third is the central bank policy, which will once again, we believe, continue its stance of an easy monetary policy. So given this kind of an outlook which we are seeing going forward, it looks like the worst in terms of macro variables could be behind us. We think the economy would bottom out somewhere in the December quarter which passed. It would be a slow and gradual recovery, but we are clearly in recovery mode right now.
So how long, according to you, this gush of liquidity can last?
See, liquidity, actually chases economic fundamentals, and if the fundamentals are likely to improve, my sense is that liquidity could sustain. Yes, I think this is a liquidity rally to start with, but India, as I say, moves on the principle of economic circularity. So when money really comes in, a lot of macroeconomic variables once again get back into shape. Our currency has got back into shape after depreciating quite massively. We're clearly seeing signs of momentum building up on number of sectors which would be starved of finance. They would start getting some uplift. We see momentum building up also on policy now to take advantage of the liquidity that is coming into India. So a lot of things fall in shape when liquidity really comes in, and therefore if this continues, you would see the liquidity staying in India.
Alroy, is it time now to celebrate beginning of a new bull market, or it is time now to exercise caution, because this current bear market rally is now reaching serious bubble proportions?
No, I think the valuations, in my opinion, are not overduly stretched. Yes, the market has moved up from its lows. To some extent, it was beaten down more than it deserved. And there's been some kind of normalization that has happened after this rally. My sense is liquidity is here to stay. As you know, there's been a big liquidity surge with the expansion of the ECB balance sheet. We expect that to further expand somewhere at the end of February, beginning March, which means that this liquidity is here to stay. There's also an expectation that you will see some amount of quantitative easing also emerging from the US. So world over, there has been an easy monetary policy, be it India, be it China, be it the US, be it Europe, and it's therefore this kind of money is going to be finally fueling asset inflation. And rather than take this just because there's been a big move in January and to assume that we are now needed to be cautious, I think it would be at this point of time a difficult call, because we do see liquidity continuing, and like I said, valuations are still not stretched. So my sense is that you have to just be careful of not investing in companies with broken balance sheets and just participate in the market in terms of buying good fundamental stocks and where you see earnings recovery and earnings of great potential, and where valuations are still quite appealing.
Alroy, your thoughts on the high beta pocket, which has surged most in this rally, but the delivery data shows that most of them are merely trading activities and not really cash buying. Would you suggest focusing on high beta banks, realty, and autos, even from the current levels?
Yeah, I would say, banks is clearly perhaps the best way to add beta in the portfolio, because I don't see any bank, in India actually going bankrupt. You do see some corporates, being pretty stressed, and perhaps, there could be some bankruptcies there, but clearly in banks, that kind of a risk does not exist. Within banks, we are actually still far more positive on private sector banks. While public sector banks have also had a decent rally, I think it's coming clearly from the fact that, liquidity tends to, move all stocks, and the fact that, you have seen an easy monetary policy which benefits all banks. But, the corporate debt restructuring, in my view, is not complete, and neither is the NPA cycle really bottomed out, in which case I would be, more having a bias on private sector banks, where the potential for this kind of NPA creation is relatively less compared to public sector banks. You can actually create fair degree of alpha on a banking portfolio by being significantly overweight, private sector banks, and that's what we have done in our portfolio too. As far as the other infra stocks are concerned, I would still be looking at asset plays, because I do see, potential for operating leverage in a lot of these asset play companies, particularly, road companies. You're seeing it in ports, but I would still be cautious on, going and chasing construction stocks, for example, where I see there's still amount of pain potential out there. They need to be having, far more, I would say, triggers for those stocks to really, sustain their momentum. So there is where you could see, some kind of pause in momentum, particularly on construction names. India is definitely needing some kind of policy initiative, both on the land acquisition front as well as on the coal policy, for momentum to build up in both, utility stocks as well as construction stocks. And I think till that comes in, there would be a cap in terms of to what extent these stocks could basically move.
Alroy, is it time now to log out of defensives, sell HUL, sell ITC, get out of Britannia? The strong days for a stock like Glaxo are over.
I would say that you have to take clearly a stock by stock view. In some cases, some of the names you mentioned have clearly filled up their intrinsic value potential. But in the case of others, you're clearly seeing potential still continuing, and you would have to take like I said, a case by case study of each of these companies. We still see positive momentum building in a number of consumer names. You're getting these names with fair degree of earnings visibility, with fair degree of cash flow visibility, with fair degree of pricing power. And I think this is the criteria one should adopt for staying invested in some of these names. The rest, we should not have these characteristics. I would completely agree with you that one should be lightening positions on those stocks.
Alroy, your thoughts on cement stocks? The big three have hit 52-week highs, or some of the oil stocks for that matter, like a Kane or OMCs. How would you recommend positioning one's portfolio and one's portfolio around these names?
I think cement is clearly, a sector which seems to have caught interest because the infrastructure per se, the SAT sector per se has not done, too well as far as fundamentals are concerned. So people basically take refuge in buying into cement names where they are, exhibiting free cash flow characteristics. We do believe that the valuations in that sector are getting pretty rich. And at this point of time, I would be a little cautious in trying to build up too much positions on that sector. Cost increases, have happened on that sector, and therefore, if you look at the EBITDA per ton in cement, they have actually contracted, and you can't have a situation where stock prices are moving up when you see a contraction of fundamentals. So I think it has been a case of more, getting exposure to cement purely because you didn't have the opportunity of building up exposure in other infra names, and cement was the best alternative. So I think that's broadly the view on cement. As far as oil and gas is concerned, my sense is that you will see policy initiatives being announced during the budget or even post-budget in terms of addressing the oil subsidy issue. which we believe will be far more favorable to the downstream oil companies, and to that extent we would still be invested in those names.
Alright, one large primary market issue is in the offing from MCX, and the other two offerings being BHEL as well as ONGC also seem to be progressing, or we'll know by today evening. How do you see them impacting the secondary market, and what response do you foresee for these offerings from the institutional side?
My sense is that any offering which has some kind of futures and options in the market generally tends to gather some interest, because some of these offerings would come at a discount to market, and there's an arbitrage play that is normally seen by foreign investors. So they normally get subscribed, and given the liquidity, some of these names could be easily absorbed in the market. It is also good from an economic standpoint, because at least the divestment targets of the government to a large extent would be met, and in that context the fiscal deficit issues which India faces also could be partially addressed. So I would believe that these issues would be absorbed. They are good companies. They are facing some business challenges, particularly in the case of BHEL. But my sense is that at valuations in which these stocks are trading at, and if you're getting a discount to market, you would basically see these issues being absorbed by investors who would like to play the arbitrage game.
Alright, if I look at across the board portfolios, by and large most of the AMCs are overweight in financials. They are fully invested, or they are almost market neutral to IT, and by and large they have an underweight position on metals. So my follow-up question is that at Kotak AMC, what is your big contra call where you are confident that serious amount of wealth appreciation or portfolio generation could happen in next 12 to 24 months?
Like I said, we are fairly exposed to the banking sector, but within that we are clearly more biased towards private sector banks, significantly overweight on private sector banks, and significantly overweight on some of the even non-banking finance companies. So that's our big bet from a market perspective. As far as other sectors go, particularly IT, we would say that we would be underweight on the sector right now. We do see the first half of IT, as far as performance is concerned, being relatively weak. This is a trend which we have seen in almost several years, where large cap IT tends to underperform during the first half for various reasons, which I can enunciate. But and therefore perhaps on a more tactical basis, it makes sense to be in sectors where we think there is outperformance likely to be achieved. So clearly on the metal side, we have been more positive on zinc. We are more positive on companies which have a blended model between steel and power. We have companies which actually have a fair degree of embedded value built in. So that's where we have taken exposures, and we have increased our weight on metals over the last couple of months.
Alroy, final question, and I don't want to get this one wrong for our viewers, and correct me if my interpretation is wrong. Can I summarize this interview with your thoughts that currently Indian markets are not looking expensive, and after a 15% run-up, you're still confident that in next 12 to 18 months, Indian markets could appreciate by 10 to 15%?
Yeah, I would say that market will always have upsides and downsides. A downside to the market now from here will have to be triggered by a global event. In the absence of any major global shock, my sense is that you could see a more positive and constructive market ahead. I do believe that Indian market is trading at about 13 times or 13.5 times forward earnings. There's a potential for the market to re-rate to something like 15 times on the back of good liquidity and improving economic fundamentals, which gives an opportunity for the market to have at least a 10% move from current levels.